What's happening, everyone? We are back, and today, welcome if you're new to the show. I am Max, and this is the second stream of the day. The first one, if you didn't catch it, pretty cool. Talked about some new stuff that could be coming in the RH ecosystem this morning, so check out that one if you're interested. And then today, we have a pretty quick one, probably go for about 35 minutes or so, with Carlos, who's been on the show a few times before, and lots of topics on as far as tax and finance and stuff go. Just search RHMax. Tax AMA or Carlos Quintana, something like that if you want to see previous streams. But again, get your questions in. Quick one today. I'll get to chat in just a moment. But without further ado, welcome back to the show. Carlos, how's it going?
Pretty good. Thank you very much. Had a nice little golf session in the morning. Nice workout. I'm feeling nice and loose.
Nice.
Ready for tax questions.
That's basically, you're at the office and you're like, you know what? I'll handle a question in a moment. I need to go take a run. That's what you normally do. Try to get your physical in shape.
Yeah, I usually wake up 6 in the morning, 5:30 lately, and hit the gym right before, and or a golf session, a quick one to the ranch, and then I go and then handle the day. Just without working out or without that, I really don't feel prepared.
Dude, I'm with you. I'm probably gonna go for a run after the stream as well. It's a good feeling. Got a few questions in the chat already, but I want to cover, before we get into it, because I know there'll be some overlap. Can you just briefly, I know we talked about it before on the show a couple of times, but can you give people just an overview of, especially in our ecosystem, there's plenty of people who could use a refresher on how you treat and have advised clients and otherwise, again, as a tax professional and stuff on hex staking, and also the PulseChain PulseX airdrop last year for 2023.
And the sacrifice too.
Sacrifice.
Yeah, for sure. I mean, it's a big topic, but we'll break it in little parts just because within those little parts there's going to be a lot of questions. So we'll start with how to classify hex stakes, and that's it's an interesting topic that we've discussed before, but I'll recap it, and if there's any questions, we'll handle those. So, for example, the first thing that we have to understand is the terminology staking. And we have to identify what kind of staking we are involved in within the Hex protocol. So to first identify all the different types, just so we can, by process of elimination, we can identify what Hex is. We can say, okay, for example, staking in Coinbase. You buy coins, you have a stable coin, and then you get a little bit of that tiny little bit of interest. Whatever coin you hold, usually there's going to be a little bit of a staking reward that you're going to go ahead and receive. And you didn't really have to engage in anything. It was just simply deposited into your account, and that would be considered something along the lines of interest. There's another type of staking where you then engage in something. So, for example, let's just say that you stake your coins in an app like crypto.com where you look up your coins for a longer period of time. There's also other types of staking where you have to engage in the smart contract, and the smart contract increases in value over time. And then that smart contract, once you liquidate it, then you get those coins. So as you can see, there's many different protocols, and even with Aave backing with lending platforms, or Nexo when it was like a thing, and all these other exchanges that might have been bankrupt already, there would be lending platforms, right? So all these types of staking are taxed differently depending on the type of thing that you're engaged in, and they could be identified as something different, like interest or other income. Now, for the purpose of staking rewards, as we have talked about so far, we want to treat them as other income. So therefore, on Schedule 1, we're going to go ahead and record it as other income. And when you do your crypto tax report, all those staking rewards, we simply classify them as staking rewards. And the report that we're going to get is the income report that then we, as tax preparers, we're going to go ahead and report as other income. Now, then we go into the monster of smart contracts. So first, what is Hex? Hex is just simply a cryptocurrency. And when you engage in the protocol, that's when it starts getting complicated, because now you are burning your coins. When you create a stake, you burn your coins. You get a smart contract that you control 100%. So you created it as the user. You create the smart contract when you sacrifice your coins, and therefore you burn them. And that t-shirt, right, or that smart contract that now you hold increases in value over time. All right. And the more time that we hold that smart contract, the more incentivized you are. So therefore, when you then have maturity on that t-shirt or have maturity on that stake, then we mint those coins into existence. So what that means is that the smart contract increased in value over time. So when we have something that increases in value over time, the way that we're going to tax it is as capital gains. So when we go ahead and have the new coins into existence, in addition to the basis that we put in as our initial investment, those additional coins, which is the yield that we call, that itself is the increased value of the smart contract. So they're going to have a zero cost basis, and they're going to be taxed as deferred capital gains. What does that mean? That means that when we sell that batch of coins, they're going to have a zero cost basis, and therefore whatever price you sell it at, you're going to pay full capital gains in it. If you select that batch and you then sell that batch in 1+ year, then it's going to be taxed as long-term capital gains. It depends on the accounting method that you use within the crypto report. It's in FIFO, LIFO. If you're in Canada or in another country, average weighted. And then there's different ways to either create a long-term capital gain or a short-term capital gain, depending on the batch that you're selecting. But that's a concept of staking.
Just on that real quick, I think the question probably a lot of people are wondering too, because you hit the zero cost basis and then paying on that, but also the ones that were burned. Do you factor that into is that like how do you come up with the number? Are those just gone, or do they count towards?
No, you link the basis and when you have it out. So for example, the way that it gets reported is that, let's just say that you have 100,000 hex coins that you put into the t-shirt, right, or to the smart contract. Well, the way that it's going to go ahead and show up is that it's going to say 100,000 hex coins to address 000000000, right? Because that's basically the way that we see whether something is burned, like they're no longer in circulation. So when we do that, you basically send it to a concept called pool. And when you send it to pool, it's like if the coins are kind of like in the ether, they don't really exist, but you send the inventory to that pool because eventually you're going to bring it out of pool. So when you then mature the stake, then a new balance is going to show up, right? It's going to say 00000 address to then your wallet address with 150,000 hex coins, right? So now you didn't only get the 100,000 that you put into the pool, but now you're getting 100,000 plus a $50,000 in yield. So your job is to match the transaction. And when you match the transaction, then that same 100,000 has the same cost basis that you originally had for what you purchased that hex, right? So if you bought that 100,000 hex for $20,000, just to give you an example, I don't know, then the 100,000 hex coins would have the same $20,000 cost basis, but then that additional 50,000 hex coins of yield would have a zero cost basis. So you have to edit the transaction when you mature the stake. You have to separate it. You have to sub-delete the transaction and then create a transaction where you got the cost base, the 100,000 hex coins with the original cost basis, and now they're a match because you didn't trade it, you didn't do anything with it, you simply deposited and then just brought it back out. And then that additional 50,000 is the added value, which we're going to treat as deferred capital gains up to the point that you sell that batch.
And that's an important point too. You're saying that up until you sell it. So if you mint it, I think we talked about this before on the show as well. If you mint it, the way you would treat it is just nothing until you trade in for cash or make another trade on it. You want to explain that?
Yeah, absolutely. So the yield itself, when you receive it, right, This is another concept. Like, for example, airdrops. When you receive an airdrop, the concept is that you're going to record it at the fair market value of that specific date in which you received that batch of coins. And this is not something to confuse with that. The yield that you received is the increased value of the smart contract, not a reward or an airdrop that you received. This is not that, because we minted those coins out of thin air. So it's not treated as that. So we cannot treat the 50,000 hex coins of yield at the fair market value as if it was just regular income, as we classify an airdrop, because it's not an airdrop. So what do? Well, since they're minted out of thin air into existence, then that has a zero cost basis value, because we didn't really put anything as far as an exchange or anything like that into it. So we don't classify it as income or an airdrop. We just simply bring the cost basis back to zero.
Gotcha. And you want to lead into the sacrifices and the airdrop that happened with PulseChain and PulseX?
Yeah, that's a heavy topic. Let me go ahead and try to summarize it as best as I can. The sacrifice, it's also, we're going to go through process of elimination, right? And because obviously the reason that we have to go through process of elimination is because we don't have direct legislation or clarification within the IRS code that says this is how you're supposed to treat PulseChain or the sacrifice or any of that. We don't have any guidance. So by process of elimination, we're going to get to the best answer. So was the money that you sent into the OA, was that a donation? And the answer is no. It cannot be classified as a donation because it's not to a 501c3. Is that a political donation? Maybe. No, it was a political statement. And also, political donations are non-deductible. So what's the next concept? Well, did I trade it? Did I give it up? Like, do I need to classify it as a disposition, meaning that you sold the coins? Because whenever you engage in business with someone and you pay them in crypto, you're disposing of the coins. So therefore, you are subject to capital gains, because it's like if you traded it. Is that? No, because we didn't get a service in return. So therefore, we didn't really dispose of those coins in that terminology as paying for a service. And then we go into, is it maybe a gift? No, because that gift needs to be classified as, and like for you to do a gift tax return, because we don't know whether the OA is an individual or an entity, and gifts are supposed to be given to individuals. So then we're out of options. Like, how do we classify it? So, it's like, okay, so now can I take a loss on it? Because basically those coins are completely gone. Or can I send it to pool? So we're in between those two. So then we're into, well, how do we classify lost coins or hacked wallets, or when an exchange cannot give you the coins back? They all fall into the same bucket. And the answer, which we just got guidance about maybe 10 months ago, was that no, they're not deductible. So if you lost coins due to the fact that you cannot get them unlocked from a Nexo or any other exchange that is going bankrupt, it is not something that you can classify as a capital loss. So therefore, you're gonna out of luck. You're just out of luck. So how do we then classify it in knowing these new concepts? That they're not going to go ahead and give you a capital loss within those coins that you disposed of. Well, within the crypto tax software, we cannot really send them to pool, because then that would show as you still have that in your account balance. So whenever you have your account balance, do you see all your inventory? So that would still show that you are holding it, but you're holding it on pool. If you want to have an accurate one, I would just go ahead and classify it as ignore or as send as a gift, but we wouldn't do the gift tax return. just because that classification is going to go ahead and ignore that transaction because we're not going to be able to claim a loss within that sacrifice. And then the other concept of the sacrifice was, well, how about the people that did the Sense Foundation donation? What do we have to do about that? Well, in that case, it is a donation, but there's a catch. The catch is that crypto donations to a charitable organization are not as if you were to do a cash donation. So simply, a cash donation is like to the church, right? You put your 10%, whatever it is, and you simply get a receipt back. You got a receipt, whoever did the donation got a receipt from the Sense Foundation saying you donated $25,000 or $250,000, whatever the money is. However, the IRS sees crypto as property, not as cash. So we have to classify that donation as if it was a property donation, meaning that if the value of that crypto donation is greater than $5,000, you need an official appraisal for it. So how do you even get an official appraisal of crypto? There's companies out there that do appraisals of cryptocurrency for specifically this type of case. They're going to run you anywhere between $400 to like $1,000. Usually, like that's the average. And even if it was USDC, you have to have an official appraisal from an official company that does this type of work. Once you have the donation receipt from the Sense Foundation and the official appraisal from that money or that cryptocurrency, now you can claim it as a donation. So whoever already did their 2022 tax return and did not have an official appraisal on the cryptocurrency that they donated, they need to go back and get that appraisal because they would fail under audit to be able to maintain their position on that. If they don't have that appraisal, that donation is going to get disallowed.
So I think you're relating to, or maybe I missed this part around, you got the sacrifice part, but then the airdrop part. So the sacrifice happened, and that's the question that comes up a lot too. Like, can people claim that as a loss, especially when they get the airdrop and it went down in value? Like, there's all kinds of questions around that. Like,
well, the airdrop was $0, right? When you got sent to us. So the airdrop, we see the airdrop, and we classify it as an airdrop. We see the massive deposit of PulseChain coins that we have in there, and we simply just classify it as 0. I mean, we on the description of the item shows up as airdrop. You leave it as that with a 0 value, and that's all. Whether it increased value or not, I mean, it was 0 to begin with, so we can't go negative. So it's 0 plus something. So we're always going to be in the positive on that airdrop. Whether it matches with your sacrifice and whether we are under the sacrifice price, that is not a tax question. That is more of your investment type of perspective because those transactions are not connected. They're not supposed to be connected. It was a political statement that you did, not in relationship to having an expectation of that airdrop happening. So you keep them separate.
Very good. Good to know. Yeah, I think these are. I'm trying to think of the most common, like you know, for the past ever since even before launch, we've been talking about how it's going to be treated and all this stuff. So that's super good information.
Mm-hmm.
Ron, I can't get to all the questions, but I'm gonna try to get through a few. We'll answer as briefly but as concisely as possible. BTFD with the first question: please discuss what different strategies look like for HIFO, LIFO, FIFO tech staking. I think HIFO is the best because it always have least gains, highest cost basis. What do you think, Carlos?
Yeah, usually HIFO. FIFO is usually better. What you have to consider is that, look, I'm not going to go ahead and discuss the numbers or anything like that, but I'll give you a perspective on what I've noticed. So, for example, I'll give you a client, Hexagon, tons of stakes, and he had about $155,000 of long-term capital gains. And then when we changed the method to LIFO, it dropped the capital gain to about $83,000. Now, your first perspective on it is that, wait, 80,000 to report is better than 155,000. And then therefore you might just go ahead and turn in that report to your accountant, and then you just simply pay the taxes on that. Now, the difference here is that for this specific client, he had some real estate losses, and he didn't really have any other income because he made a ton of money with a hex stake. So that was his year to retire. Now, when we then calculated what kind of, like specifically on the dates, on the transactions. Now, I'm giving you this insight based on me working in the tax return already. So you're going to have to work with your accountant to know which one is going to be better for you, because you're not going to be able to see it, because each one of those transactions is going to have a different date that you classify. And just simply by having an Excel report is very hard when you have 1,000 transactions, so you basically have to just upload that Excel report into the tax software to see which one is going to have a lower tax. So now, in the $150,000 example with FIFO, we then saw that it was long-term capital gains. And specifically to this client, the tax on it was only $3,000 for $150,000 of long-term capital gains because of a little bit of real estate offset, plus there was no other income. You have a preferred tax rate when you have long-term capital gains. From 0 to like 45,000, you pay 0% on long-term capital gains. From 44-something thousand to like 80,000 or something like that, then you pay 15%. And then anything above that, then you pay 20% long-term capital gains. But it's not like you pay 20% on the whole thing. It's broken out into the different brackets, and then it's a combined average into how much you pay in long-term capital gains. So the short-term example with 80-something thousand, now he has to pay ordinary income tax. If you're reporting $80,000 in income, that's going to be like a 22% tax bracket. So then the tax was a lot greater than the $3,000 that we were able to calculate on the $150,000. So just by looking at the report, you're not gonna be able to make a decision because you don't know what the consequences of long-term versus short-term are. In my perspective, FIFO has always been even though you might have a greater amount of capital gain because of the length, because it's first in, first out, because of the opportunity to have longer wait times for you to sell those specific batches, it creates a lower tax than LIFO, for example.
Gotcha. Very interesting. Fox Modder, are there tax loopholes that are uniquely suited to crypto?
I mean, I don't like the word loophole because that constitutes something illegal or something kind of getting around the system or something. We have to play within the rules. And I think that within the rules, the changing of your accounting method, it's something that you can definitely work with. As long as you're using a tax software, so this is an opportunity, right? As long as you're using a tax software that coordinates your transactions and creates your balances and calculates the cost basis, now you are able to have a specific ID accounting method. Specific ID accounting method allows you to have a range of choices of the accounting methods that you would like to choose, because now you have identified each transaction and you have reported it on the form 8949 instead of having a summary of your transactions where you don't identify the transactions. So by having that and having specific ID, you can play with FIFO, LIFO, HIFO to see how that's going to go ahead and be convenient for you. As far as avoidance and capital gain, yeah, sure. I mean, there are some, they're not specific to crypto because crypto is just capital gains. There's nothing more than that. It's as if you were selling real estate. It's capital gains, it's property. So that's the way that we see it. So is there any tax strategies for you to then defer capital gains or avoid capital gains? Yeah, there are. You can do a opportunity fund where if you would like to get into real estate, then you can develop your own opportunity fund and then defer capital gains and then avoid capital gains on that specific asset. But you see, you have to see what you would like to do with the money. And we're not talking about $5,000. Like if you're like here for $5,000 and you're asking for a loophole, get out. It's like, no. We need to be talking about 500,000. We need to be talking about $2 million. So a tax strategy can make sense, and that you have the power and the opportunity to create something with yourself. So when you have these type of tax strategies, you need to define what is it that you like to do and what is it that you would like to engage in. If you would like to engage in real estate, great. This is a great conversation to have into the real estate conversations to see how we can defer capital gains and get into real estate. So therefore, you don't have to pay capital gains with that specific transaction. Well, those specific transactions that happen within crypto. If you want to get into the stock market or have a diversified portfolio, we can go ahead and talk about creating. If you already have your own company, how can we move money into an 831B plan? How can we set you up with all these different types of retirement accounts and make it deductible from your ordinary income, so then you don't feel the hit on the capital gains? So there's deferral capital gains, there is reduction of income, maximizing deductions, there is sheltering of income within retirement accounts or investment accounts, insurance. There's all these multitude of things, but specifically to crypto, I think that the best thing that you can have, Fox Mulder, is playing with the accounting method. Really getting into the depth into what is going to be more convenient for you to see how your tax report is going to look like at the end of the year.
Yeah, and me and Carlos literally played cash flow game online during a stream. So if you want to learn about money and investing, that's a great game to play for yourself and with your family, or just watch us play it and have different commentary. That was a really cool stream. I really like that one. Briefly, Archie, LL tax strategy, that is liquid loans. Carlos, I know we talked about a little bit about loans and taxes, but yeah, you want to just briefly cover that one?
I mean, it's not really a tax strategy. It's just a non-taxable thing. I guess that could be a loophole, if you want to call it a loophole.
Don't get liquidated.
As long as you don't get liquidated, because then that becomes a taxable event for sure. But if you want to have liquidity without having a taxable event, then you're more than welcome to do so. I mean, I'll share a little bit of my perspective on it. At a certain point, I'm going to go ahead and sell whatever Pulse I have. I'm not going to hold it forever.
How dare you?
Hey, I like Pulse, but we have this concept that we have to break, which is diamond hands. No, you are in crypto because you wanted to have. No one is in crypto for the technology, seriously. So if we're gonna be here a little bit, okay. All right. I mean, 99% is not, for the technology.
Not relevant for this conversation, at least.
Well, they want to make a change in their life. They want to make a change in their life by having liquidity and being able to purchase things for themselves. So we have to change this concept of diamond hands and to try to time the market into the top to then be able to liquidate. We're not going to be able to do that. Like Richard Art has talked about it many, many times. It's not about timing the market. It's about the time in the market that you spend in here. And we have to make sure that we listen to that wisdom, because when you are then into a certain position where you have to liquidate because now you have life-changing money for yourself, or you're able to buy property, or you're able to change your family's life with it, I think that you should do it. And if there's tax consequences, I mean, just make sure that you plan ahead for it. But liquid loans is, for example, a really good strategy for you to achieve liquidity in a shorter period of time, I think. At a certain point, I think that, exiting the market is also a good thing, and then getting back in if you wanted to, or only a portion of your portfolio, I think is wise to do, as long as you have enough to achieve the things that you wanted to do to begin with.
Life-changing wealth, nothing like doing real life stuff and going outside. There's outside. I don't know if people know that.
There's buy some property, man. Excel in your career, get more certifications, build up everything. We can't just rely on crypto being our savior.
Another one from Fox, trade some stuff in Roth IRA, pro tax-free profits, have to wait till 65 or 62 and a half without withdrawal, without penalty. Yeah, any commentary on Roth IRAs and crypto?
That's a great thing. So I trade some stuff in Roth IRA. Tax-free profits, yes, of course. Yeah, have to wait till 62 withdraw without penalty. I think that's just more of a statement, and it's a true statement. I think that the only concern about that is that the contribution amount is only $6,500. So you're limited to the amount of money that you can put into the Roth, but it's definitely a good strategy. And there's a new regulation. If you have a 529 plan for your kids that you have funded and there's excess amount of money that is not going to go into college tuition, now you can actually roll it over into a Roth IRA, and you can go ahead and trade with it, and you could use it for your retirement account, tax completely without any tax consequences. I think that's an amazing strategy for a lot of people that have kids and that want to go ahead and utilize the Roth IRA account. But I think that the Roth opportunity is great for some people. I've heard some other bad stories about it. I've heard some really good stories about it as far as like who you have as a self-directed IRA custodian. So I think that you just have to do a little bit of due diligence who you have your Roth IRA with.
Yeah, for example, I mean, kind of dovetailing this in the PulseChain too, in the whole copy. I mean, Rocket Dollar or anyone else with a self-directed IRAs. So if you had Hex or PulseChain, or I guess you don't have PulseChain, but okay. So 2 points on this. If you could you have sacrificed from your IRA wallet, and then what do you do with your Hex copy on PulseChain that will be sitting in your wallet had you held Hex?
Yeah, well, I mean, first, there's no tax consequence on the sacrifice for the Roth IRA because none of it is taxable. The distributions are going to be the ones that matter anyway. So nothing gets reported within your Roth IRA. You don't have to worry about tax reports. You don't have to worry about anything. So that's one topic. And then you said what happens with a copy that you got on the Hex. By the way, I can still see my balance of the Hex that I got copied over into my MetaMask. I gotta see if I have the right Hex contract address. But I see my Hex stakes though on Pulse. I do see those. So I mean, they just showed up in the wallet. If they have a value, they could be classified because you took control of that contract, or I mean the wallet address. When you saw the balance,
it started at zero value, right? The airdrop, everything started at zero value. But yeah, I guess technically you do have control over that wallet if you exercise it, I guess.
Yeah, I mean, PulseChain Hex didn't have value up until the point that there was liquidity inserted. It was just a ratio trade that happened at the beginning. So when you got it, it was zero value. So it's just going to show up in your tax report as an airdrop with zero value. There's really nothing much more than that. I think that the other topic that we have to talk about is, well, now that you have PulseChain and you have a PulseChain wallet, how are you going to integrate that into now your wallet? I mean, into your crypto report. How do you synchronize that now into your crypto report? Because now people are trading, they're getting the incentive token, they are using the PulseChain ecosystem, and they are having all these Hedron stakes and these stakes and the Res or whatever it's called. I mean, there's tons of different coins that people are getting involved with in the PulseChain ecosystem, and they have similar type of dynamics as Hex does. They're just like Hedron, right? Like that is a very similar type of way that we're gonna go ahead and see the stakes. It shows up as 000, just as if it was a burnt type of transactions. You send it into pool, you get it out of pool. You have to analyze every single type of token or protocol that you're getting involved with to see what you're gonna classify it as. If you are getting staking rewards from delegating your coins, or how do you call those? The proof of stake delegators? No, what is it called? The actual programmer validator. Yeah, if you're a validator, for example, like that's going to be either self-employment income because you're running a business. If you delegate, that has been proven that is going to be taxed as regular income. The Tesla's case that was happening is completely thrown out the window. Now we have clear instructions into how to classify proof of stake staking, and therefore it's going to be taxed as ordinary income. Depending on what protocols you're getting involved with PulseChain is how you're going to classify it. But now the struggle that we have as tax accountants or helping people out, or even the people that are sending me messages right now, is that they're having trouble synchronizing the PulseChain blockchain into whatever tax software they're using. I know that Coinly is the one that I like to use the most, is having a lot of issues with PulseChain and not recognizing values from the PulseChain blockchain. So I really don't have a recommendation right now. I have to still discover which one is going to be the best one. I'm playing with Coinly. I'm playing with Panda. I am also playing with Crypto Tax Calculator, and all of them have been able to launch the ability to synchronize your PulseChain wallet. But in every single one of them, I have found different things that are not correct. So I'll come back with you guys with a suggestion about it, because I'm interested myself into finding a good tool that will help us synchronize all of our PulseChain transactions.
Sure. I just want to do a time check real quick, because I know you got to go at some point, but you got more minutes or less? Or what?
Yeah. I mean, is there more questions on the...
Oh yeah, there's quite a few questions. I'm trying to get to just a couple more if you
let's try to crack them out.
Okay. Let's see. Fox again. Any tax difference for selling and leaving proceeds on a CEX versus offloading to your bank account, the form you haven't taken possession? My opinion, but the IRS doesn't see it that way. What do you think of that?
What is a CEX?
Centralized exchange.
Oh, centralized exchange. Okay, so any tax difference selling and leaving the proceeds. It doesn't matter. As long as you interact with an exchange, as far as like trading a coin, whether it's a centralized exchange or a DeFi, Matcha, XYZ, doesn't matter. As long as you trade one coin to the other one, it's a taxable event. It doesn't matter if you did it to USDC to USDC. We record the transaction. If you send it to your bank account, irrelevant. As long as there's a trade within the blockchain, we're going to record it. So that's completely irrelevant. Now, in the former, you haven't obtained possession IMO, but maybe IRS. No, we haven't ever had that where, I don't know what IMO is. What is IMO?
Oh, in my opinion.
Oh, in my opinion. Okay, informer, you haven't obtained possession, in my opinion. Yeah, I think you're right in your opinion. My opinion is the same, but the IRS doesn't see it that way for sure. Is even if you did USDC to USDT, that's a trade, even though there's the same cost basis. Yeah, so any transaction is going to be recorded.
European well, in Hexco, we don't need to pay tax. One day, European well. BTFD, wouldn't hex yield just be earned income? I think you covered this, but yeah, just briefly.
No, it wouldn't be, because you're not engaging in you're not providing a service to anybody. Income, right? We have to distinguish income versus ordinary income tax. Ordinary income tax is basically the tax that gets populated on just regular income that we receive, whether it is passive, active, doesn't really matter. Ordinary income tax is basically populated by the tax bracket that you're in. You make 400,000, you're a 32% tax bracket, 35%. That's ordinary income tax. Now, would it be earned income? No, absolutely not, because you're not providing a service for anybody. Now, would you call it, maybe the confusion is this one, because they changed the language to mining, and mining is earned income, but they just changed it to get, it was a marketing thing. We're still not mining anything. We're not securing the network, and Hex is not a blockchain. You're not securing the network, and you're not like in Bitcoin where you're securing the network and you have a computer system where it calculates mathematical problems and it solves mathematical problems for you to then be able to verify the ledger. You're providing a service, you're validating those transactions, and therefore you would have earned income with that. But Hex is not a blockchain, so therefore you are not validating anything, and therefore the word mining is invalid in the tax terms. So no, to answer that question is no, it's not earned income.
Lucky 33 question: if you spend crypto in other countries and decide to move, how would double taxation work?
If you decide to spend crypto in other countries, Or these are, I mean, spending crypto in other countries is going to record because you're doing it from your wallet. It doesn't really matter where you spend it. It could be in Mars, or it could be in Dubai, or it could be in Portugal, or it could be here in the United States. It's irrelevant. If you're spending crypto for a service or an object like a Ferrari or a house, you are disposing of that asset, and therefore you are going to record it as a transaction. From the original cost basis minus the proceeds equals your capital gain or capital loss at that moment of recording the transaction. And then double taxation means that, well, if you do move, and then let's just say that, well, I mean, those are, let me distinguish a couple more concepts. Double taxation, it's only when you have earned income in another country and then you're a U.S. citizen or a resident here in the United States, and you also have to report that income here in the United States. If you've already paid taxes in that other country for that earned income, you don't have to pay taxes here in the United States because there's something called a foreign tax credit, and therefore it eliminates double taxation in the countries. So you only pay taxes in one country. In this specific case, in the example, the phrase of spending money, it's irrelevant because maybe she's referring to like sales tax, but you can get a refund on sales tax once you travel back into the United States, which is completely irrelevant to double taxation. So earning income is what refers to double taxation. There's no double taxation depending if there's a tax treaty with the United States, Germany, UK, a lot of countries in South America and so forth. Where there's no double taxation. And if you decide to move, well, it depends on your wallet balance. If you decide to move, there's something called an exit tax. So you basically, but it's in conjunction with decide to move and renounce your citizenship of the United States or your green card. You renounce it. And then you go to Dubai because you want to cash out your millions of dollars tax-free. If you don't renounce it, you're still subject to having tax preparation here in the United States, and you'll still pay the tax here in the United States, right? So, but then tax credit applies into that. But if you do have a balance of like assets of greater than $2 million, you have to pay an exit tax. As when you renounce your citizenship or your green card, you pay the exit tax. I don't know what the percentage is. I forget. But then at that point, if it's lower than that amount, you basically renounce it, and then you can move to Dubai, wait for your balance to then go above 2 million, 6 million, whatever it is, and then cash out in Dubai. Okay, fine. But do you really want to renounce your citizenship or your green card? It really depends on how your situation is in your life. I love the United States. I'm not planning to move. So for me, renouncing the United States citizenship is just not an option unless I had maybe $100 million and my life is going to be way better. But at the same time, I like the United States. So.
Yeah, that's what I see. A lot of people, a lot of people like Puerto Rico. They like, Dubai, whatever. For me, it's like, I don't know, there's a lot of trade-offs, and I prefer, even if I had $1 million, I can't see myself renouncing.
In my opinion, the United States is one of the best countries in the world. I mean, obviously there's better healthcare, blah, blah, blah. You can make an argument about it. I like the United States. I love the United States. I'm grateful.
Money tends to take care of healthcare. Get $100 million. Boy, you can buy some healthcare. Don't worry.
You can buy a hospital, probably. A small clinic, right?
That's true. No, yeah. All its problems, it's got some good stuff here for sure.
What if you bought real world stuff? Same thing. Hold on, my battery is dying. Let me just plug it in. One second.
Okay, sure. Everyone, I hope you appreciate Carlos taking time. He had short time, but he's taking more time for us now, which super appreciate, because he's got a wealth of knowledge on a lot of topics. No worries. Yeah,
we already touched on this. If you buy stuff, if you pay for services, it's as if you disposed of that crypto, so therefore it's going to get recorded as a capital gain transaction.
Sure. Have you heard of a DST, Deferred Sales Trust? Have you worked with
Yes.
trusts?
Yeah. Deferred sales trusts are very, very famous. Don't do them. They are in the dirty list of the IRS.
No? Okay. Good to know. Let's see. Just scrolling. There's a lot of questions. Just trying to pick the best ones real quick. Well, actually, I think they cut off there. Let's see.
Yeah.
It's stress from the bear market deductible.
Jesus, yes, it is.
You're on a roll. You're doing well. Yeah, that would be nice.
I know.
Actually, I think it's it. There's one other thing. Again, anyone you get a free one if it's quick. One thing I wanted to ask though too, because we had you on the show before the Chad list of 11 lawyers came for Richard Hart. I want to get your commentary on that too. Like, have you like now that he's presented the legal team, all that stuff? How are you excited about this year, or are you like, do you feel more confident? I know you talked about it before, like, hey, this is, if everything goes to zero, it's fine. I kind of went into it knowing all this stuff, the risk and all that stuff too. But seeing his presence and him not back streaming yet, but he's got this legal team and response on that stuff. How's that give you any faith in the ecosystem this year?
Not really. I mean, I still think that it's going to have a negative impact when someone is dealing with a legal issue. I am kind of counting not much in Richard Hart doing that, because he's going to have to deal with whatever he has to deal with. I'm counting more on the bull market, because everything just goes up with the bull market. Now, the ecosystem has been launching a pretty cool ecosystem, and I think that PulseChain being a fork of Ethereum at way cheaper, automatically that makes it a attractive platform for a lot of people to do their trading or do whatever it is that they like to do. There's a lot of liquidity providing. There's this, there's that, there's incentive token, and there's a lot of cool protocols that people are going to go into. So I think that as we study the history of crypto, there's kind of like an ecosystem pump. After Bitcoin pumps, there's an ecosystem pump, right? Like the dot ecosystem is probably going to be one ecosystem that pumps, and then there is the Avalanche ecosystem that pumps, and then now that Cardano is out, there could be the next one to be out, as far as a pump. So we recognize that when Bitcoin pumps, it pumps, but then when people start taking liquidity, then they put it into Ethereum as far as the ecosystem, and then when they make a lot of gains on Ethereum, then they put it into all these other ecosystems. And I think that I'm betting more on that as a cycle type of bump that PulseChain naturally is going to have, other than my perspective on the legal circumstances that Richard's going to go. Because even if Richard has a case, every time, like for example with Ripple, even if Ripple had a good case, and we knew that it wasn't a security transaction that they had, they still went through the legal trouble, and we saw how the sentiment of trading was pretty bad, and how the coin went into a bear market for longer than any other coin. And now, I don't know, I don't check prices, so I don't know how they're doing, but I still don't think that. Yeah, like the fact that Richard has a legal team, I'm happy about that, but I still think that he's right along the way. I don't think that this is a security. We know, all of us, that Hex is one of the best protocols out there, and it's now that the websites went into this now security, that the websites cannot be taken down, IFPCS or whatever it's called, IPFS. Like, we know that this is one of the greatest type of crypto coins, but does that even matter when the sentiment is negative? I don't think so. So, well, that's my perspective on it. Hopefully I'm wrong and then become super millionaire, and that'll be great.
I would like to be a super millionaire as well. I'm with you. Yeah, no, I mean, I think interesting out of your point too is just believing in, if we're going to get green candles, it's going to be because of the market cycle, and relying less on Richard blowing the case out of the water. I think that's an interesting perspective for sure.
I mean, I've heard other perspectives that he is the one that took it to the 10,000x. I've heard so many different stories, man. I like, what do you believe? Just believe on your own due diligence and your own perspective on the investing that you do. Keep on working on your career. Keep on investing in real estate. Keep on investing in the stock market. Keep on investing a little bit of crypto because it's a speculative asset. Be careful.
Yeah. And any narrative, like, it's funny, like you bring that one up, like any narrative you could turn it positive too. It's like, oh, he did the 10,000x before. Well, what if he does it again?
I want to count on that too, because like now I'm like, I want to cash out. But whenever it's expected, it never happens.
Yeah. One other question. There's a few in here. Sorry, everyone, I can't get to all of them, but I want to get one just because it's interesting. I don't know, it's super relevant, but Fox Modders hit out of the park again. Gas fees deductible?
Yeah. If you're mining, they are deductible. You have to account for them, and the tax software is going to go ahead and see them. But usually the gas fees, the tax software that you use is going to integrate it into the cost basis. So in a certain sense, the cost basis increases with the gas fees, and therefore the capital gain would be lower. So to general answer, yes.
Wow. And just one more too, because I think kind of covered it, but you weren't sure on the tax software part. Is there anything that you recommend right now, or are you still getting clarification on tax software people for them to use?
I don't have a recommendation right now with specifically to the topic of PulseChain integration. All of the ones that I have tried, they're having trouble recognizing the transactions. But the best one with the best user interface that I've seen is Crypto Tax Calculator. Coinly, for a fact, I know that it's screwing up a lot of the stuff with PulseChain, and people are having a lot of trouble with Coinly. So I don't have a recommendation. I mean, you're going to struggle anyway. I think if you're trading and doing all these different stakes within PulseChain, we're just going to have to wait and see which one is going to be the best one. I mean, we're starting tax season right now, so I'm barely engaging in conversations about it. So maybe in a month, maybe I'll have an answer for you. Maybe I'll just send it over to you via text, and then you can just post it or something.
Yeah, man. And I mean, that's a great segue too. If for people who have more questions or otherwise, how can they get in contact with you?
My Twitter, I think, is a great one. I think is at, what is it? Carlos de Quintana? Or what am I at? Crypto Tax?
I think it's I think your name is Crypto Tax, but your handle is Carlos de Quintana.
At Carlos de Quintana. There you go. You can just look me up and send me a message. I'll be more than happy to engage with in conversation with someone.
Yeah, I've got Carlos's details. Also, you have that's your website, right? carlosdequintana.com.
Yeah, I don't really check it. If they send a message through there, they can just message me on Twitter, and I'll be more than happy to just respond and route them. If they want to become a client, I have a process of onboarding. I'll tell them about it.
Gotcha. Man, always good to have you on the show. And yeah, like I said, I know you get busy in tax season, but anytime you have the burning desire to come on stream and talk about this stuff, we'd love to have you back. Always a good show.
For sure, man. I appreciate you having me, Max. It's always a pleasure to be here.
Of course. Everyone out there, hope you got your value today. Your free 53 minutes of professional tax advice. Not for me. I don't give you any advice, but this guy's seems to be pretty good at his job.
That wasn't advice either. That was just information.
That was just he's off the clock right now, so just don't. Yeah, take it for what it is. All right, everyone. Scivive and 5555. We are out.